Prosper is going to talk about the business life cycle and debt implications. Prosper has a knack of presenting difficult and complex concepts simply, so that we are able to understand these concepts in our own context. Prosper is the senior partner at Bridgewater, the investment banking outfit. So, Prosper, give him a hand. I know we've just had lunch. Give him a hand. Yeah.
Thanks, George. George has made things very interesting for me. In terms of making complex things simple. I hope I'm able to do so. And I was looking forward to seeing Julius. Julius. So Julius is like, it's like that friend who you go and you go and buy food, and then you say I'm going to use the washroom, and you come back, he's eating all. So Julius has done the job. So my bit is very light. It's going to be short because I have with me, I'm sharing this session with Dr. Samoa, correct? And he's going to do a more dense part of this presentation. I would say, if we can give it up for Julius again, his session was great. It was a good one. I am not as charismatic as him. As he was moving to and fro, I was just admiring him, So my session is basically going to touch on business life cycle and debt implications. As Julius mentioned in his session, there are a number of senior professionals here. I'm assuming we are a little bit familiar with the concept of business life cycle. But I don't know, are you guys familiar? Do you know what a business life cycle is? If anybody opts to help, just like Julius, I'm open, you can come in at any time. So my session is basically going to take us through the business life cycle, the business risk curve. We'll look at the capital implications in that, and then we look at the corporate demise curve, and then debt considerations for debt management. So when it comes to the concept of business life cycle, I like to look at it like what we see. So typically, every business goes through a cycle. If you look at an economy, at any given point in time, you would find businesses at various stages. So this is a plant, right from the early stage. The middle point is where you see it, flower looking so good, but then there's a possibility of it dying. Now the question is, what influences death, right? And whether or not there's a concept such as natural death. Is there any concept such as natural death? Should we think every company that exists will die one day? Is it a fair assumption? That's a hard one to think about. So, or is death imposed? Does it come from somewhere? So these are the kind of things we have to think about. Now this is a plant, but in the context of a business, businesses typically tend to have 4 to 5 stages in their life cycle. So the first phase is called the early phase, which is where you would have, we say concept development, ideas that are seed. They are just businesses that are as ideas in people's minds. And then they develop the concept. From there, they try to put the concept into motion by starting up. We have several stories of businesses that go from concept to start. I think one of the most famous in our generation is Facebook and what it's been able to do. I think we've seen the likes of Uber and many more. But moving from a stage to another is not guaranteed. there are several factors that would influence how a business makes progress. So, from the startup phase, the next is the growth phase. When the business is introduced to the market, it begins to tweak its business model to meet the needs of the market and begins to see changes in some key variables which I'll address. So we call such businesses growing businesses. Now, for a country like Ghana, where we have about 90% of our economy being SME driven, the interesting bit is most businesses are between early phase and expansion. That is the reality we face in Ghana. And from expansion, we go into, or within the expansion phase, there's what we call shakeout. Really, every business, starts as a concept, you try it out. Then you begin to experience the market and you begin to define where your focus area should be. So, maybe you thought about selling 6 products. You realize that perhaps, let's focus on 2. Or let me say for professionals, you thought about having a full practice, and then you change your mind, let's have a boutique. So there's that shakeout. And what shakeout does is it gives you focus and then begins to drive your business model because you understand your market better. And that moves you to the maturity stage where a business is comfortable in the marketplace, where a business is making all it can in terms of revenue, building up cash. There are few examples we can look at, but I wouldn't go in there yet because I think it can be quite controversial. Right? Now, the last phase of a business is decline. This, I personally don't find it very comfortable addressing this line this way, because this line assumes that every business will eventually die one day. But really, like I said from the beginning, it's something that we have to look at and see whether or not it's something that we should hold constant or otherwise. But the key question here is, how do we define the level of a business? And for all of us here, for the interest of restructuring, insolvency, the key point here is businesses can be distressed at any level. It's not as though a business goes all the way to maturity and then dies. You can have businesses that get into distress right from the beginning. We have businesses at the growth stage getting into distress. But the key thing here, if you're a professional and you were to be engaged on a distress scenario, I think one of the key things you have to define is where to place the business in the life cycle. Because the parameters around how businesses function in the life cycle varies. The environment within a growing business is completely different from a matured business. Right? If you take a growing business, a lot of things associated with systems, policies are not as defined. Very few bureaucracies, heavily built around founders. So is it fair to say, if you take over a business as an administrator, is it fair to say in your review, pre-appointment analysis, is it fair to say a business has weak corporate governance if it is a business at the startup phase, for example, where the business is heavily driven by the founders? So I think these are some of the things we need to understand with that clarity that, businesses go from stage to stage. And at any stage, they can be distressed. So there are a few variables that can be observed. These are just examples in determining where a business is placed in the life cycle. So variables such as growth in sales, profits, assets, and these things are all industry dependent and must be placed within an economic context, the macro environment. So we are going to have a little discussion. I'm going to engage everyone here on, we know a lot of businesses in the market. Without prejudice any business, we will try and place businesses merely by observation within the life cycle. Perhaps you could share your thoughts on what you think. So if I go back to the life cycle with our observation in terms of businesses that we have around us, for me, I'll start by saying, if you look at a business like MTN, one would say it's matured, but why? Right? I would say MTN is matured because it's had a certain level of consistency in performance when it comes to growth over a sustained period of time. And when we look at the kind of volumes that MTN is doing in the context of the industry and over the period of time it's existed, I would say MTN is a matured business. So I would say that business variables must be observed over a period of time. So in terms of determining whether a business is early stage growth or matured, it's not just an observation as of today. You can't look at a business today and say it's a matured business. You can't look at a business today and say it's declining. You have to observe it over a period of time. You have to do some trend analysis. Then someone will ask, so what about if the business doesn't have any history? Well, then it's a startup, which is quite clear. So mere time does not determine the stage of a business in the life cycle. So the fact that we've seen businesses in my kind of work, I've seen businesses when you're raising capital for companies, a lot of financial institutions who would want businesses that have a certain level of performance that have existed for a certain period of time. Banks typically will say 3 to 5 years and all. And you hear some companies say, well, we've been in operation since 1960. But there's nothing to show. So really, such a business, if it's a measure of time, that doesn't guarantee where a business lies within the life cycle. Is there anyone here who can suggest positioning any business that we know? Julius, I'm expecting one from you, by the way. So if you can suggest, based on what I've just said, or if you have a view on what I've just shared, you can feel free and come in. But if you have an entity in mind you think you can place somewhere within the life cycle and share your thoughts on it, that would be great. Is the lunch working? Lunch. Julius, the anointing us. So, any ideas in Ghana, around us? Wow. I think it's a question for all. Mechanical Lloyd. You know, we haven't looked at the numbers, but just by external observation, where can we place Mechanical Lloyd?
I think Mechanical Lloyd is currently out of business because is it the franchise or whatever? I don't know. It's a licensing agreement that gives them is it BMW? That thing is gone. Is it BMW? Yeah. Yeah. So they are out of. So I'll put them in. Can you please go back to your so I'll say decline. Possibly extinct. Yeah. Extinct.
Okay. So that's any other
On the Mechanical Lloyd again. I wanted to.
Okay, please go on if you want.
I think when maybe I'll put Coca-Cola at the matured stage. I mean, Coca-Cola has been in existence for who knows how long.
Yeah.
I mean, so many years, and it's still one of the top beverages operating. I mean, worldwide, you can go to every nook and crook and you see Coca-Cola there, and they are still doing well. So I think they've matured. I mean,
Right.
they've gone past the startup growth, and they've
They are up there.
Yeah.
So should we expect, if we are to go by the assumption of natural death, will it die one day, perhaps?
I think the death can be prolonged. I mean, their lifestyle, their existence can be prolonged.
All right.
Yeah, unless maybe they decide that we are tired.
Yeah, I get it.
Yeah, but it can be prolonged.
Okay. I think that's fine.
Okay. I think if we go back to, back in history, where we look at the fact that the joint stock company was created to basically divorce management from shareholders, and therefore to give the business perpetual continuity. It is, I think, the concept that every business must die does not sit well with me. I think it depends on how we define business, the business concept. And when I'm talking about the business concept, I'm not talking about the corporate personality. I'm talking about how that organization or company creates its money. So changes in the external environment will require businesses that want to continue to essentially have a relook at their strategy and their model of engagement in order to survive. Dinosaurs got extinct, Human beings continue. Yet, so if you don't adapt your business model to the present, to the realities of the changes in your external environment, yes, you will die. You will certainly die. And that is talking about the business concept. So if an organization acquires another organization, it acquires the business of that organization. They are distinct. Perhaps Professor Samoa might touch on that a bit later. So maybe we could say that as you have the convergence with of banking industry and the telecoms industry, some might say, banks are destined to die, but you need to look at what is the business of that bank. What is the business concept? Not so much as the corporate personality of that bank. Thank you.
All right, thank you. Okay. So thank you.
Thank you very much, very good friend, Prosper. You've taken the life cycle off. I just want to draw attention to something. This looks linear, as if there is a termination point. But businesses rejuvenate themselves. We can take the case of ExxonMobil, Total. You've gone back, okay. Oh, okay.
I'm helping you.
Actually, I was going to talk about this because at every point in time, if you are in the growth stage, and there is any element within, and you see the business sees that it is going to the slow death stage. If the business does not react by merging with the concepts elucidated earlier by the first speaker,
Julius.
Julius, merger, acquisition, injection, capital, etc., you will by all means die. But many businesses actually, when they get to maturity, they don't just, if you want to stay alive, you have to keep afloat. Some of them will jettison, if it's a product line, they will either rebrand or do something new to regenerate the business, to maintain themselves to be in the growth state. So it looks linear, but it's like it looks something like this. As you are going, you have to find something to wake you up, to get back on track, and that kind of thing. And then you can live 100 years, we don't do the next. Thanks.
All right, thank you. I think there are a lot of experts in the room. Please, let's give him one round. And I think he just nailed it on the head. Basically, that was going to be my next point. there's room for a business going downward to revive. The whole idea is every business exists at a point in time. You can look at it even if it's a spread of time to address specific issues. And these issues are called the needs of the market. And these needs will change over time. And so when it changes and your business model does not change, you would go downward. So basically, I think my good friend has handled it. But one thing I want to say here is there are core variables. You know, earlier on I was talking about how to determine where a business is based on certain variables. These variables behave differently at various stages in a business's life. So at the beginning of a business, revenue is very low. You barely have cash, barely make any profit. Well, but that in itself is not reason to conclude on whether a business is failing or not. Facebook had an IPO when it wasn't even making profit. You know, so these are examples of businesses at the early stage struggling, but their situation cannot be put in the same basket of, for example, a matured business struggling. Now, whether or not the cash line, you know, cash is not the same, revenue is not the same as cash and profit. And cash is not the same as profit. I think Julius did a lot of work on, you know, defining insolvency and all that. I didn't go into it. But whether or not your cash line falls below the profit or above is dependent on how you run your business, the kind of mechanisms you have in place, and whether the gap between the profit and the cash line is also dependent on the nature of the industry you are in. Certain industries have huge cash lines, others don't. So let's bear this in mind. The next thing I want to touch on is the need for capital. Now, every business really needs to define or answer the capital question. And what typically happens is anytime a business tries to grow, automatically there'll be a capital gap. That's what happens all the time. So we can take it from the beginning. Before a business comes into existence, it will need capital. Now, if the business operates at one level and tries to transition, there will be that capital gap again. And at every point in time, the business must figure out how to deal with this capital issue. And the decision around dealing with the capital issue brings in the concept of capital structure. So businesses must decide the two main brackets, be it debt or equity, how to figure out the capital issue. But the interesting thing about this is it's not all dependent on the business. It's not all within the capacity of the business to decide how its capital structure will be per se. And that introduces the concept of what I call the business risk line. Do we have bankers here? Any bank here? All the banks are gone. Oh, yeah, yeah. From any credit department? Credit? So you guys are my friends. So I'll need you at some point. I have a question. So this is how it plays out. When a business starts, the red line there, that is where the risk is at the highest. And then as the business begins to prove its business model, risk begins to decline. Now, capital behaves differently on this line. There's one bracket of capital that doesn't seem to move that much. That's your equity line. There are different sources of equity at every stage in the business life cycle. Right from the beginning, I'm not addressing raising capital here, so I'm not going into the types of capital, but Right at the beginning, you have shareholders, funds, and all that coming in. You have family and friends coming in. Equity is there if you can raise it. No matter how, excuse me to say, dumb the idea is, you can find an investor. It could be your uncle. It could be a relative. Then as you go up the life cycle, the other equity, both private and public sources, that become available. But interestingly, this is how debt behaves. Debt has an inverse relationship with the business risk line. So, please, the bankers here, we've heard the stories about banks don't fund startups. Is it true? And then they get upset. And they say the banks are not supporting the economy. If you don't invest in startups, then what happens? Please, if any banker can speak to perhaps any reason, bitter experience of giving to a startup, or why banks don't give to a startup. I know there are regulatory issues in there, but if any bank can speak to it, I'll be very glad. But really, this is the reason. I personally don't fault the banks. I have zero issues with the banks when it comes to this, because when you understand the wider bracket of capital and you understand the business risk line, you kind of figure out why the banks take that position.
Yeah, Prosper.
Yes.
So what I can say is for commercial banks, our source of funding is a bit short term. So whatever business we intend to do has to focus on the short term perspective in terms of returns. So in that respect, it will be quite difficult for us to fund startups because the uncertainties are quite wide and it becomes difficult to account for it to our short-term lenders or short-term investors.
Thank you. Please, your name and I think your name and...
Samuel from Stanbic Bank.
Okay, Samuel. Yeah, any other contribution? I think I saw a couple of hands from the banks. But I think what Samuel said is really what I've said. If there's anything to take away from this slide, I would say let us understand the banks in the funding model they operate. When the risk is very high, lenders don't tend to come in. And really the reason for this is because of the characteristics of debt. There are two things about debt that makes this quite critical. One is debt always has a fixed term. No matter how you look at it, you have to pay back at some point. That is not the nature of equity. So for debt, there's always a duration, and then you have to pay back. So where the business risk is high, and you can't sort of figure out the business model, the nature of your cash flows, it is very, very difficult for lenders to come in. That is why debt builds up as you go up the life cycle. And so as we are here dealing with the subject of insolvency and restructuring, really the issue begins to build up when companies tend to grow. That is where the whole point is, because there isn't really any debt market for young businesses. That is the fact. There are other capital avenues for young businesses. I'm not saying that young businesses cannot borrow at all. I'm just speaking about the wider body of knowledge when it comes to this. Just because of the way debt functions, businesses need to understand where they are and therefore the type of debt available to them. Now, that brings me to the next bit I want to address. So this is a little universe of, I'm not going to go into equity, I'm going to focus on debt, and I'll just touch on this briefly. Yes, debt exists, but like someone said earlier, banks tend to give short-term credit and all, but the whole idea is that anytime a business, as I mentioned earlier, anytime a business tries to grow, there's need for capital. Now, a business growing that is reliant on debt may have to decide, or not may, but would have to decide how it approaches debt and the questions that it answers with debt. Now, the business would typically, for growth, you need to invest. I think Julius spoke about give and take. You have to invest in growth. And this investment is typically captured in capital expenditure. Right? Now, but long-term debt is the best solution for capital expenditure. But there are also short-term requirements. For example, when you are into, say, juice manufacturing, you decide to increase your capacity from 100 bottles a day to 1,000 bottles a day. You tend to increase your factory floor, your equipment, so on and so forth. All these are equipment. And you need to make some capital expenditure for this purpose. The moment you do this, you'd realize that you start having short-term liquidity gaps. Why? Because perhaps you used to just order 100 pineapples for your production. Now you order 1,000 pineapples. So your payables shoot up, and you have to figure out how to meet that short-term requirement. So what often happens is that when a business tries to grow and takes on more debt by way of capital expenditure, at the same time, there's a gap that is created when it comes to short-term funding. And what is really important is how businesses carry out this allocation. Now, the misalignment of this can cause serious problems. The bankers here, I don't work in a bank, but they'll tell you some businesses buy Land Cruisers from their overdraft. Am I right? Yeah, you buy Land Cruiser from your overdraft. What's going to happen? That's a short-term debt solution, investing in a capital expenditure item. So what is going to happen is you're going to run dry. First and foremost, short-term credit is way more expensive than long-term. So your cost is going to shoot up, and you're going to have problems. Do you have any questions or contributions at this point? The banks, I'm doing your work for you, so if you can.
Thank you. My name is Sharif, and I'm from KPMG and PMO. Regards to this graph, I just want to find out that is it possible that at the maturity stage of a business, the risk will become zero? Because that's the sense I get from this graph. Yeah. Is that possible? That at some point, the risk that a business faces will become totally zero? Thank you.
That's a good question. I mean, this is relative. So I think earlier on we tackled the issue of matured businesses. My brother from PwC mentioned that Coca-Cola, for example, is quite mature, doing well, existed all these years. Now, we can't have a thing such as zero risk. We've even seen the government situation. You know, we say risk-free, and now we are all hit. You know, so we can't really have zero risk. However, we can assume that at some level, risk is at its barest minimum. Okay, so I'm not going to, I just try to address some few, I'm running out of time, so let me just speed it up. So these are just some few sources of debt. I'm sure you are all aware of this. Two brackets, private debt markets and public debt markets. Private debt markets looks at all the bank, private debt funds, finance houses and all that. Then you look at the public debt market where you look at bonds and all that. So this is just a quick one. The next key thing I want to tackle is debt capacity. I think when Julius was handling his session, he did mention, he said something along the lines of how a business decides to borrow. I don't quite remember the specifics, but really there's a concept called debt capacity. And the debt capacity of a business is defined at a point in time, but interestingly, it is not static. That is the whole idea of debt capacity. And there isn't any standard formula per se, but really debt capacity is what can you take and pay? And when you're answering the question of what can you take, it's not just in volume, what can you also cover in terms of security? Okay, so there are some key considerations you have to look at. in defining your debt capacity. Are we okay with this? So I think, like I mentioned earlier, one of the key things to bear in mind is debt capacity changes over time. So debt capacity today, the basis on which a certain credit was provided, may change. And that is why businesses get into trouble sometimes, because the debt capacity has changed. So what influences debt capacity? A number of things, internal and external factors. Really, that is what influences whether or not a business stays afloat. So I have some few factors here for internal issues and external issues. I know, interestingly, most Ghanaian business tend to be very, well, from my experience, not Ghanaian businesses, but we Ghanaians tend to be quite religious and spiritual. I quite remember I have a client where we did a deal for in the region of 20 million, and then COVID hit. And I called the client and I said, look, there's COVID, and from our analysis, it's going to hit you. What should we do? Should we start talking to the banks because you are exposed? He said, oh, you don't have faith. You don't believe. I said, no, this is serious. He said, you sit there and think that, oh, your analysis and all your computer language. He said, come to where I am and see. We pray. Yeah, but this is the reality, you know. So, yeah, there are a number of factors that influence debt capacity. We saw a threat to the debt capacity, so we tried to reach out to the client. And this is depicted here. So the bank or lenders will give a loan and they have an expected performance. Then over time, external and internal factors may influence the business. And you see the debt capacity go downward. And what it does is that it creates a hole. So this line is called the corporate demise curve. And you see debt capacity going down, whilst expected performance is at a certain level. So this is just an introduction of the the corporate demise curve, which is better explained here, where you see a business move through the stages from growth to underperformance, and then it gets stress, distress, and then gets into crisis. And like all what Julius tried to handle in his session, manage the issue of crisis and then possibly come out of crisis. Now, like my good client, who is still in business today by the grace of God, you know, so, you know, it's quite interesting to know how it happens to businesses. So this is also the corporate demise curve, but this particular here tries to depict how businesses relate to it. So on the left is the business. Now, when COVID hit, I reached out to my clients and I said, hey, the macro environment is changing. You better watch out. Let's engage the lenders. Because he was comfortable, he was in trouble, but he was not aware. You know, so he was okay. He didn't have any knowledge of external factors coming for his business. Then the next stage is in trouble and taking control. So in this same situation, I'm sure if he's listening to me, he will just stone me after here. But anyway, this client reached out to us and said, look, the COVID thing is for real. It's hitting me seriously. So can we engage the lenders? And I said, yes, why not? So we started a process of engaging the lenders, basically revising cash flows, doing some impact analysis on the numbers in order to justify the case. So, thank you. Yeah. So, we were able to handle it, and that was a situation of taking control whilst you're in trouble. But if we go past that stage, which I've also experienced with this whole COVID situation as well, you can totally lose control, where it gets worse, and that's a crisis stage, and then you eventually would have to need business rescue. If not, you go down the drain. So I conclude by just touching on some key considerations in debt management. One, proper allocation of capital is important. Earlier on, I spoke about the fact that you may misalign your long-term needs and your short-term needs. Debt structure is also crucial. Reason being that you need a proper structure in your debt to be able to service it well. For example, if you're in construction, you need 24 months to build a commercial property, and then you have your tenants coming in, and you take a loan without any other source of income. That requires you to start paying after 3 months. You are bound to get in trouble. So the structure of the debt is quite important. Monitoring of debt indicators. There are some few indicators. You know, when a business takes on debt, sometimes they assume it is the responsibility of the bank to monitor the indicators. But the finance department or the company must also keep eye on some key indicators. For example, there's the debt service coverage ratio that shows the business's ability to meet the obligations. I think these things have to be looked at. We've had a few clients who have to, help in that regard. And then, being realistic with cash flows. A lot of businesses, particularly in our jurisdiction, where businesses are SME and led by few individuals, if not an individual, who have a lot of faith and believe in God, they tend to be very optimistic with their cash flows. And then the business model. A business model is basically how a business makes money. I mean, how the business operates in order to create value. You have to constantly look at the business model. Whether or not the business model is relevant, what are the changing dynamics in the market, and what you can do to stay afloat. The last bit is openness with lenders. I think that's the last bit. I always encourage businesses to be open with lenders, because the lenders, to be very honest, they can't do anything anyway, because they are in the same boat with you. I think most banks have what we call relationship management, because it's assumed to be a relationship. So if you are open with lenders and you are true from the beginning, it's very easy when your dynamics are changing to engage lenders. So ladies and gentlemen, this is my little bit on the business life cycle and debt implications. Thank you. Any questions, contributions?
Yeah, thank you. I don't know if I heard you right. You said that any time that the debt is going to increase, it's going to have a toll on your liquidity, or there will be a pressure on your repayment ability. Now, if that were to be true, then right from the word-go, you are having crisis. What we do as bankers is that if, when upon the debt going up, if it is not commensurate with the income that you are going to generate, so as to pay us, then we will not, right from the word-go, even consider, or we will decline the request, the debt that you are increasing. So I just want you to throw more light as to either, is it a case that anytime the debt is going to grow, that is going to have a challenge on the liquidity, as you said. Thank you.
Okay, thank you. Give your name and I think.
Oh, I'm called Justice.
Okay, Justice.
Yes, sir.
So, Justice, this is with the assumption that debt is held constant. There's no growth in debt. So this is basically saying that if debt is given at a certain point in time, there's a certain level of expected performance. If the dynamics of the market begin to change, it will influence debt capacity. It has nothing to do with the bank. It's to do with the business and its ability to service that debt. So then it creates a gap. I hope that's the case of Ghana, as well. We had certain assumptions and parameters around macro performance. We couldn't keep up. Debt performance lines, if you hold it constant and the dynamics change, there'll be a hole.
I don't think that if Ghana had invested, I don't think that we would have got it to where we were. But we just borrowed to chop. Yeah. That's the case. We didn't invest to generate a commensurate expenditure. Anyway.
Yeah, thank you. Just as for Ghana, we'll talk later.
Let's give Prosper a hand. Let's give Prosper a hand.